Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is, of course, the 6th of February, and we are trading in open early trade in Asia. Brent crude oil just popping its head above $80 a barrel on Brent and 73.57 on WTI, closing on Friday on Brent below $80 for the first time, I think, in a month, more or less. I mean, started the year just below 80 and seemed to end after somewhat of a schizophrenic January, one might say, trying to get to 90, then back to 80 in the same place. Let's kick off Monday morning with Omar Najia, as always, Global Head of Derivatives at BB Energy. Omar, this is a market looking for direction. Does it have any yet?
I mean, this is a market that got absolutely destroyed. It's not a market looking for direction, right? So we started 2-3 weeks ago, everybody was saying, China, China, China. And that, money's coming in and peak inflation, and here we go, right? And that was supposed to be the narrative. What did the market do? It fell out of bed. I mean, it literally collapsed. It went from, WTI went from 82.44 down to 73 something, right? I mean, that's not a market looking for direction. That's a total collapse. So if a market is being told that, everything is great and the news headlines are bullish, like I was saying last week, why does it keep going down? I mean, if that's the driver, why does it keep going down? So we have to think two things. Either traders have no idea what they're doing, and basically the narrative is bullish, or the headlines are bullish, but they're selling it because they're silly, or the news, something else is driving this push down. And what could that something else be? I think basically, if you look at not only this, but if you look at the broader market, so if you look at everything from equities to currencies, everybody has suddenly turned bullish. I was reading over the weekend stuff from the Wall Street Journal saying bullish bets are surging. We're in a bull market. There's a CNBC buy on the dip. And then we had basically Barron saying the bulls have it in 2023 and last year's losers are winners, stock market and a bull market. So everybody's gone raving nuts. So the maximum pain, I think, is going to be to the downside. So before I was sitting on the fence a little bit, and I was warning that basically, when all this stuff is, the narrative is so bullish and markets are collapsing, that's a negative sign. And I think you have to be careful that you don't look at like something like equities and see equities ticking higher to understand that the economy is strong. So basically, I don't think we're going to get to new highs. I think we're going to fall out of bed. I think oil is leading the way. If we manage to come off another dollar on WTI and take out the previous low, which is 72.40, something like that, then I think we're really going to accelerate to the downside. So I think that what the market is following, what traders are betting on, is a broader downturn. So basically, market started weak in 2023 because everybody was wary, and then all of a sudden everybody's been told that the worst is behind us. Everybody's piled in, so I think it could be time for a rug pull, and I think you've started to see that on WTI, and I think equities are going to follow. So I think strategically, short term, we've moved massively. I mean, the move, even though we closed like $2 down on Friday, the move was actually from 78 down to 73. That's we closed down $2.50, but we actually moved down $5 on the day. I mean, that's a trouncing. That's a massacre.
Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Your thought, Marks, on the massacre on Friday, which came in the same window as this massive job increase, growth, creation in the United States. The markets hated the good news that the U.S. economy is just still doing so well.
Yeah, well, I mean, Omar's pointed out, I think what the salient point is we are basically still swinging around on massive pendulum swings in sentiment. And a lot of it is basically driven by the fact that the Federal Reserve, the ECB, the BOJ, Bank of England, have not really taken away a lot of that excess liquidity that was put in during the pandemic, let alone what was put in beforehand. So that liquidity is still looking for a home. It had a bad year last year, and we are basically reacting the whole time to US bond yields and bond yields elsewhere. So we had a great reaction to the Federal Reserve and the ECB and the BOE, even if one actually, when one looked at what all the central banks said, no, they didn't push back against the easing in financial conditions, which was surprising. But on the other hand, they didn't say, oh, by the way, that's it, we're done. Happy days. We're really happy with the economy. And so markets, what we've got is this excess liquidity hunting a home, and at the same time, underlying market liquidity being horrendous. Now, we know in the first couple of weeks of the year, we had a massive shift in market positioning. If you look at the net long position in oil and oil products. So what we've had basically is people being wrong-footed, and we're going to carry on being wrong-footed simply because no one really understands what's going on. They don't understand why, with all these rate hikes that we're having, why the US labor market and indeed labor markets elsewhere aren't basically, the tensions in them aren't easing. And the answer is basically, we've had
what's 5%? I mean, come on, at the end of the day, when you've printed $10 trillion, what's 5%? It doesn't seem to be sufficient to calm the waters here. Walter Simpson, welcome back to the table. Of course, Managing Director of CCED in Oman. Walter, are we going to be surprised? I mean, the flip side of this coin is China is coming back. China is reopening, and we're literally only going to start to taste that now because finally the Chinese Lunar New Year festive holidays is over, and it's kind of back to normal business now this Monday morning, literally. Your outlook for where China may surprise in its sort of demand outlook for the year ahead?
Well, good morning, and thank you for welcoming me back. I'm not sure it is going to surprise on the upside. I think it depends a little bit about how much stocks they've really bought on the lows over the last few months / years, and how much that's going to be fed into their increase in demand as to what they go to the international markets for. But I think you're right. I think they're definitely coming back, and I think that's going to increase demand overall. Whether it's a massive jump or not, I'm questioning that one, but I think it is going to increase demand. And I think the volatility we're seeing is what I would expect. With Mark's point, people don't understand what's going on. They're not quite clear why things are going the way they are. That means that every piece of news, people look to reinforce the view they have about what's happening and react accordingly. I believe I'm trying to navigate the smoother path through the middle of this. I feel as though this sort of price is about right. And I suspect here and maybe a little bit higher is what the OPEC plus countries want. And I think they'll do their damnedest to keep it at these sort of levels. And if that means messing with their demand or quotas again, I think they'll take a serious look at that.
And meanwhile, Walter, China's probably still buying every barrel that Oman can deliver. No indication that that's changing.
None whatsoever.
Omar, when you take that into consideration from the supply side, I mean, clearly there's still a very significant healthy demand. Is $80 or 70 something on WTI just the sort of fair price that, without the distortions of the Ukraine war, this is the zone we would have been in for the last year?
No, I mean, the good thing about WTI is that it's a forward-looking market, right? It doesn't care what demand is today or tomorrow. If China's coming back, it's already in the price, right? So they've been saying China's coming back for about 2 weeks now. So they don't kind of, wait around it. Okay, now it's really coming back and start to buy, right? So it's a forward-looking market. So what the market is sending a message, at least right now, is that they don't care about China. So it's not something that's driving the price of oil, right? If China's coming back, it's going to keep coming back, and we're going to keep saying it's coming back, and then it's going to come back. And then the market is not looking at that right now, right? So the discovery, if you like, is what is the market looking at? And I think what the market is saying is like, the market definitely has been wrong-footed. A lot of people were extremely long, and I think a lot of people are still extremely long. And I think you could say that broadly about all markets. And when you start seeing basically people heading for the exits, you get the kind of market reaction that you did. So I think the market is going to head lower. I think the same on equities. I think the risk that the world faces is a lot lower prices. I think to have a bull market, I mean, you have to kind of extinguish this bullishness, this rampant bullishness that we've had on the back of
but the
QE
point
for
that
so
Mark
many
just
years.
made there, how do you stamp it out when you've literally got $10 trillion of liquidity looking for a home after all of this stimulus and everything else? People just have too much money. Bankers and fund managers need to find a home for it.
So basically the way you do that is right now, everybody, as you say, is looking for a home for it. So they want to buy the dip or buy anything that moves. So basically you've got to scare them so that they don't put any money in equities at all. In fact, you've got to scare them so much that they sell what they have. So even the people that are bearish are not outright short. They might not be increasing. So basically, when this market starts to go, it's going to start liquidating stuff that's already there, not putting money in or putting new money in. You've got a long way to go, I think, for this market in terms of downside. So risk, I think, is still a downside.
It's certainly, I mean, speaking of a kind of the counterintuitive moment of all counterintuitive moments, the FTSE 100 reaching a record last week at the same moment that the UK economy is apparently about to go into some greater level of implosion than everybody else. Mark, this is the Monday morning in the sort of the morning after the night before when the EU embargo on Russian exports of products is to come into place. And to some thinking is that, well, because of the disruption to products out of Russia, that they'll have to export that as crude. And so hence there's just this excess supply of crude on the back of this embargo. Similarly with the US, given the maintenance season, more crude available there. So just generally speaking, just more crude and hence a softness on the price. Your thoughts on the EU embargo as it comes in and its impact for the crude market?
Well, I think in general, with all of these things, the product will be displaced. So it will find its way somewhere else. One can balance this out. Basically, the EU is ensuring that it pays more for all products because it's embargoed, all of it. Other countries will exploit the opportunity, whether it's China, whether it's India, whether it's GCC countries, and they will benefit from it. And that's probably the way I would look at it. There will be displacement. There will be some problems for the EU to a certain extent. But as we've seen with gas, basically with the economy slowing down as it has, people seem to over-celebrate the GDP numbers. At the end of the day, people were saying, oh, great, it's plus 0.1. Well, if it was plus 0.1 or minus 0.1, well, we're talking about an EU economy which is running at stall speed. The plus and the minus are around zero is totally irrelevant. It's a financial market construct. It's not really something for oil traders or commodity traders to really look at because it's irrelevant. So I think probably the more important part is if we're going to displace all this product, who in the middle of all of this, all the middlemen, whether it's insurance, shipping, is actually going to get squeezed because it won't be, basically the buyers are being told you're just going to have to put up with higher prices, and the sellers basically saying, yeah, okay, right, well, the processors, particularly elsewhere, are going to benefit from it.
Walter, we've had two big voices over the weekend expressing views on the market. The Saudi energy minister, of course, the sort of biggest actor in OPEC Plus, warning against shortages that could come on the back of these sanctions. And then also the IEA executive director Fatih Birol warning or urging oil producers to have to reconsider their output policies to increase supply following the China reopening. I mean, those are two kind of strong signals that there might be a shortage and hence more supply needed, but yet OPEC Plus held its sort of firepower last week. Would you expect OPEC Plus to move on any of this, i.e. more supply to cater for their biggest customer, China, coming back?
An interesting one. I'm not sure the supply's there, if you see what I mean. I mean, the quota is available, but whether anybody can fill it is a different matter. I think it's an interesting things going on here. You know, with Omar's doom and gloom, and there's a downside to come. And there's, you know, why would you invest in more capacity, and why would you look at putting that into the market if the price is going to go down? So people sit on the fence a bit about investing, and we know that there hasn't been the investment in this industry over the last few years that's needed to keep up supply into the future. And the only part of the world that's really committed to investing at present is the OPEC countries, particularly the GCC, working very hard at it. And other areas are sitting on the fence saying, oh, I'm not sure about this. I don't know if I can get the money. I don't know if I want to put it in there. You know, all on the back of this uncertainty in the market. So I think all this is playing to be good for this part of the world, to be perfectly honest. I mean, this is where the bulk of supply is going to come from. And this is just playing the game into their hands in allowing them to get more and more of that supply. So I think OPEC becomes a much more important player going into the future, and unless there's investment from elsewhere, and I don't see that at present.
Omar, your thoughts on the this kickoff of this embargo on products? I mean, distillates, middle distillates, the refining margins remained very attractive. You would think Russian exporters will be doing all they can to find a market.
I think basically people have a short memory. So we've had this kind of discussion before, right? So at the beginning of last week, you had all these reports saying that, you know, this coming ban or this coming restriction on products from Russia is going to basically cause a shortage, blah, blah, blah. You had Goldman Sachs come out and say, you know, you should buy because it's going to be terrible. In 2024, there's going to be shortages. You've had Anjuran, who are this fund who are extremely long, came out and said that, you know, China coming back is going to add, I don't know how many 100,000 barrels to demand. You've had all this kind of, you know, hyping, and the market has gone the other way. I think the market knows that there are a lot of people who are very long and are trying to talk their book and trying to basically G the price up, and they're going to get absolutely squashed. So I think basically that this news is already in the market. I think basically that there is no more good news to come because they've shot all their bullets. And now we're going to see, I honestly, I think basically this week we're going to start smelling a bit of panic. I think basically people are long tracks, very long tracks. I think people are long structure. I think people are long flat price. I think basically people are more kind of, you know, so nobody's, you know, even when I speak now, it's quote unquote doom and gloom. So until what a bearish kind of view becomes not reality, but not doom and gloom, but a possibility, then I think this market is overvalued, not only on crude, but on equities and on commodities. And I think basically that, you know, I think basically this market is going to keep selling because I think that they know where the length is. It's going to be like this, you know, I forgot what that company is, the Adani destruction, this company that lost 50 or 100 billion or whatever it is, right? Because everything is fine, everything is perfect until suddenly it's not. right? So
Until
I think you're looking
suddenly
at that
it's-
kind of stuff. Yeah, that's my opinion.
Mark, on the sort of development. I mean, the oil embargo is obviously related to the Russia's invasion of Ukraine, and we're now looking at a potentially major ramping up of that conflict as we emerge out of the European winter. Where do you think the intersection of those two things will go in terms of the re-emergence, if you like, of Ukraine back onto the front pages of destabilizing the markets?
The Ukraine war is above all basically a disruption to global trade. So it basically acts as a counterforce to the optimism about China, and China all leading us out of the rather weak economic outlook that we had up until China dropped its zero COVID policy. We're probably at the problem here again boils down to this pendulum swing in sentiment. We keep on swinging. Everything either is wonderful or it's terrible. And the truth of the matter is it's somewhere in the middle. We're going through a period of great change and upheaval. And as Walter was talking about, steering a path through the middle is basically the best policy here. There's no question about it. It isn't, because markets are volatile and they're going to remain volatile. I think the difference between this year and last year is very simply that the war has been going on for a year, will have been going on for a year very soon. Another offensive is coming. Just because it's become so entrenched, the risk of a more radical position from Russia and a bigger escalation has to be considered to be even higher than it was before. In the meantime, we're all trying to adjust to all this displacement that we've going on, and actually trying to understand the global economy. And it's not just markets; it's also central banks, because they haven't got a clue either. Or let alone the politicians. The politicians are absolutely hopeless in all of this.
Well, you even had Larry Summers last week going, well, let's just take a pause here so we can make some sense of things. Even his sort of voice, which was sort of very much an early warning on the inflation side, seems to also be coming to the fore, that there needs to be pause in order for clarity to come.
Absolutely. Yeah. No question about it.
Let's go to the survey question, which is sort of the point I was hitting on earlier. China's oil demand will recover to pre-COVID levels quicker than market currently expects. Agree or disagree? China will surprise with balloons and all. It'll be a big party, balloons and all. I saw a very funny sort of comic over the weekend where the balloon was coming in delivering Chinese takeaway, which was quite had to giggle. The moments like this certainly bring out a bit of humor. Walter, outlook for, as you were mentioning earlier, is this a year where we will see more money go in the ground? We're seeing record profits across the industry on the upstream side. I mean, in large, obviously on the majors printing massive amounts of money, and yet there seems to still be a pullback from investing in the ground. Your thoughts on where the industry as a whole will go this year with the revenues that they made last year? Can we expect to see supply growth?
I think it's going to be tough to see a large supply growth this year, but I think you'll see considerable investment in building supply in this part of the world. I'm more skeptical about the international investment, particularly with the IOCs. I think they'll make returns to their shareholders. I think they'll make a lot of noise about investing in renewables. And I think they'll be more cautious about investing in oil and gas. And we'll see where that goes. But I'm absolutely confident this part of the world will invest heavily in building their supply side.
Is that, Walter, because the IOCs will find it less attractive due to supply constraints in terms of supply chains, materials? There's just too much inflation in the supply chain, or is there a more practical reason why they're not investing as they would have in previous cycles?
I think it's a combination of the sentiment from investors, the access to the capital, the return from the years they've had low oil prices and not been returning to their investors. The supply chain is absolutely an issue, but also the challenges we face in the market at the moment. You know, what is the oil price going to be? Is it a good investment right now? Should we sit on the fence for 6 months, see what happens? What's going to go on? And I think that's going to cause a pause in investment rather than immediate decisions. You know, to Omar's point, the uncertainty means people take a second look before investing, and that delays things.
Well, in some ways, Omar, seems that we've moved into certainty now towards the downside rather than the upside. Omar, your sort of closing thoughts is with oil trading a little bit up this morning. According to Reuters, the reason is because IEA Fatih Birol talked about China coming back quicker than expected, but and he doesn't have a book to talk up. He typically likes to talk prices down.
Yes. So basically, before it was like you should be bullish because China's coming back, and now that we've gone down like $8, $9, $10 a barrel, you should be bullish because they're going to come back quicker than expected. So no, I don't think Fatih Birol. I mean, I have no idea, but you know, I don't think he has really any kind of skin in the game day to day. Maybe he looks at things like, you know, a year down the road or whatever it is, but you know, day to day. The only point I'd like to make is basically you need when everything rallies like it did after the Fed came out and said, okay, 0.25% and all this kind of stuff. When everything goes up, when equities go up, when gold goes up, when literally everything goes up, that is not a healthy state of affairs. That shows you basically that there is a lot of optimism on the sidelines. So to have you need to have a healthy market. You need, you know, when you start a market, people are saying like, no, they're pessimistic, markets won't go up, and then markets start to go up, and then they start to come in, then they get optimistic, then they got euphoric, and you know, that's how you build a bull trend. Right now, we're still at the euphoric kind of stage. So I think we need to come off. Once we do that, then you can start talking bullish. But I think markets need to come off and come off heavily.
Let's give Mark the last word with the survey result here. China's oil demand will recover at pre-COVID levels quicker than market currently expects. 3-1 agree with that statement. So whatever that was worth, we'll post that on social today. But Mark, I wanted to get your views of can we be certain about one thing today that the markets have sort of rallied on so far this year, and that is that we've reached peak rates and inflation is on a downward trend. How fast it goes keeps going, but nonetheless, that general narrative of January that gave that big upswing to financial risk assets was peak rates, declining inflation. We could bet on that, or is that even a question?
I'd say there's that's an open. We are close to peak rates. That's definitely true. We are not going to get any rate cuts by the end of the year unless the real factor, which is the big negative for markets, above all for equities, we are in a massive earnings recession. And it certainly looks like that way outside of the oil sector. The oil sector is going to have a great deal more challenges this year, obviously. We've been talking about the input costs. Those input costs are the same for everybody. What people are forgetting is we've got cumulative increases in inflation, and that's what companies and businesses are having to deal with. Those increases aren't going to suddenly go away. And it's going to be that much more of a struggle in an economy which isn't firing on all cylinders. And I think that's the key point for people to take on board.
Yeah, it does seem to be a disconnect that you can have, the outlook for declining rates and a soft landing. I mean, those two are sort of somewhat incongruous. If you have a soft landing, rates at least in normal economics, do not go down. But we will have to see. It is interesting times. Nonetheless, the optimism in these markets just doesn't want to go away. It's been dominant for a decade now. It'll take a lot to slay it, I think. Walter Simpson, thank you so much for joining us this morning from Muscat, Omar Najia from Dubai, and Mark Oswald from London. Really appreciate your time with Brent crude oil, as I said, trading just above $80 a barrel. Nothing too exciting on it, just a slight blip above 80. It doesn't seem like a lot of wind in the sails there, probably waiting to see what happens when Europe opens. Have a great day, everybody. All the best.
Thank you.
Thank you.